A stretch of Southern California real estate generates close to $1 billion in annual sales. It runs through parts of 5 cities: Westminster, Garden Grove, Fountain Valley, Santa Ana, and Huntington Beach. More than 11,000 businesses operating inside its borders. Over 49,000 people employed. Commercial plazas, medical centers, high-volume gold exchanges, jewelry wholesalers moving serious weight. By any standard, this is a functioning economic fortress. But according to every traditional Wall Street metric, this empire had no business existing. The people who built it arrived in America with almost nothing. They were Vietnamese refugees fleeing the fall of Saigon. Zero United States credit history. No domestic income, no physical collateral. It was 1980. Federal lending rates were suffocating the economy at 21%. American banks denied the vast majority of their commercial startup applications. Locked out of the formal financial system, they didn't wait for the door to open. They built a completely different door. They resurrected a decentralized, cash-based shadow banking network that moved hundreds of millions of dollars. It operated entirely without a single legal contract. And the people running it? Mostly women. This is the forensic breakdown of that hidden capital machine, and exactly how one refugee community used trust as a financial weapon to take over Southern California real estate. The year is 1980. The American economy is choking on stagflation. Federal Reserve Chairman Paul Volcker takes extreme measures to force the market into submission. He cranks the prime lending rate to 21.5%. Money is suddenly the most expensive it has ever been in modern US history. Traditional commercial banks lock down. They demand extensive FICO credit histories, provable domestic income, and hard physical collateral before touching any loan application. Now step into that frozen credit market as a newly arrived Vietnamese refugee. You escaped the fall of Saigon. You have massive human capital, skills, work ethic, drive, and an intense need to build something. But on paper, you do not exist in America. Zero US credit history. No domestic assets to pledge as collateral. Your formal financial footprint is a blank page. Loan officers at California banks turned away the overwhelming majority of Vietnamese refugee applicants seeking commercial startup capital. The formal financial system had no mechanism to evaluate them. Many communities would accept that verdict and settle for low-wage labor indefinitely. A high-trust network denied access to formal capital does something different. It builds a parallel economy. To survive, they bypassed the banks entirely. They resurrected a financial network called the HUI, a rotating savings and credit system with roots going back centuries in Vietnam and across East and Southeast Asia. Do not mistake this for a simple cultural tradition or a neighborhood savings club. In practice, it functioned as an aggressive, uncollateralized lending syndicate. Capital pools routinely ranged from $10,000 to over $100,000. All of it moved in cash. No loan officers, no application fees, no corporate oversight, no legal contracts binding anyone to anything. The entire structure rested on a single critical node, the ledger keeper, known in Vietnamese as the Chu Hui. And here is one of the most underreported facts about this system. The Chu Hui was almost always a woman. In Vietnamese communities, both in Vietnam and in the diaspora, women ran these networks. They organized the groups, vetted the participants, collected the contributions, and managed the capital. In America, where their husbands were often consumed with starting and running the actual businesses, Vietnamese refugee women became the central operating nodes of the entire shadow banking infrastructure. The Chu Hui would build a circle of 10 to 20 trusted individuals, all vetted personally, usually drawn from family, extended community, and verified business connections. Each member committed to contributing a fixed amount of cash every single month. This instantly created a massive concentrated pool of liquidity out of thin air. But this creates an obvious mechanical problem. Every single participant needs startup capital right now. So how do you decide who gets the lump sum payout first? You don't draw straws, you run a bidding war. The payout mechanism operated through a competitive sealed bid auction. Here is exactly how the math worked. Imagine a syndicate of exactly 10 business owners. Each person agrees to a base contribution of $1,000 per month. The cycle runs for 10 consecutive months. Month 1, no bidding. The Chu Hui collects $1,000 from all 9 members, adds her own $1,000, and claims the full $10,000 pot. This is her upfront compensation for taking on the systemic risk of organizing and guaranteeing the group. She is now a settled node. She must pay the full $1,000 every subsequent month, no exceptions. Month 2 is where the financial engineering starts. The remaining 9 participants are active nodes. Any of them can submit a bid. A bid is a discount offer. A member who needs cash urgently submits a number representing how much they are willing to let every other active member deduct from their monthly payment. Say member A desperately needs capital to open a restaurant. He bids $150. If his is the highest bid, he wins the pot. The one settled member pays the full $1,000. The 8 remaining active members each pay $850 instead of $1,000, the $150 discount he offered. Member A collects a total of $7,800 in cash. He voluntarily accepted a $2,200 discount off the face value of the pot, but in exchange, he secured instant, uncollateralized liquidity at a moment when every American bank had turned him away. He transitions to a settled node. He pays $1,000 every month for the remaining 8 months. This mechanism functioned as a highly efficient, unsecured commercial loan priced entirely by urgency and community trust rather than FICO scores. It injected capital directly into the local economy in a way the formal banking system was incapable of doing. The greatest systemic threat to the Hui was a complete default. The Vietnamese community called it Jut Hui, taking the pot and vanishing. Traditional American defaults trigger a legal process. Banks seize physical collateral, freeze accounts, and drag you through civil court. The Hui had none of these enforcement tools. The cash existed entirely off the books. If a member took their payout and stopped contributing, the Chu Hui absorbed the loss personally. She kept the pool solvent out of her own pocket to protect the remaining members. This is not a minor footnote. This is the load-bearing risk that every ledger keeper carried. These women were personally guaranteeing networks that moved hundreds of thousands of dollars. But the defaulting member faced something arguably worse than a lawsuit: social excommunication, immediate and total. The Vietnamese enclave in Southern California was a closed-loop economic ecosystem. Business owners shared the same wholesale suppliers, the same landlords, the same informal hiring networks. A Gut Hui severed you from all of it. You could not access informal capital again, ever. No future Hui membership in any circle. Vendors would cut off your inventory supply chains. Your business starved without support from the community network. Your name circulated as someone who had stolen from their own people. In an enclave this tight, that reputation was permanent. The cost of betrayal was engineered so high that the system maintained an extraordinarily low default rate despite having zero legal enforcement mechanism. Trust was the collateral, and it was more reliable than most things a bank could seize. Cash moving in a briefcase does not construct a commercial corridor. To buy physical land, the shadow capital had to be washed back into the formal financial system. This required a specific sequence, what we can call the leverage cascade. Step 1. The ignition switch. The early cash payout went toward purchasing physical retail equipment, industrial kitchen equipment, jewelry display cases, a nail salon setup. This equipment launched a real, operating retail business, the first step to generating documented revenue. Step 2. Document the invisible money. Business owners meticulously tracked every dollar of profit flowing through their operations. They filed an IRS Schedule C tax return for 2 consecutive years. That specific piece of federal paperwork changed everything. It converted off-the-books wealth into legally recognized corporate revenue, visible to the formal banking system. Step 3. The institutional flip. These business owners walked back into the exact same commercial banks that had rejected them years earlier. This time, they carried 2 years of federal tax returns proving their revenue. The lending algorithms had no choice but to engage. They used the bank's own leverage to purchase physical real estate, the strip malls they had originally been leasing. They went from tenant to landlord using the bank's capital, backed by a business funded by the shadow system. The compounding of this process across hundreds of families simultaneously is what turned one neighborhood into an economic fortress, and then one man put it all on a map. In late April 1975, a 27-year-old Vietnamese man named Frank Giao boarded one of the last American transport planes out of Saigon. He and his wife arrived at Camp Pendleton with $50 between them. His first job in America was selling Kirby vacuum cleaners door to door in Whittier, California. He quit after a month and became a security guard. Within 3 years, he had taught himself real estate, gotten his license, and in 1978, founded a commercial development company called Bridge Creek Development. Zhao began buying inexpensive, undeveloped land along Balsa Avenue in Westminster, land that most American investors ignored. He was tapping into the same community capital networks that were now generating documented revenue, channeling that activity into permanent real estate. By 1987, there were more than 550 businesses operating in the corridor. Asian Garden Mall opened the same year, a 150,000 square foot structure funded with capital from Asian investors, built with financing from American banks. Over 4 decades, Bridge Creek developed more than $400 million worth of shopping centers and residential buildings across more than 50 acres. Zhao became landlord to over 1,200 Vietnamese businesses. The community called him Chow Phu, or Godfather. The Los Angeles Times called him Godfather of Little Saigon. And he started with $50 and selling vacuum cleaner. The final participants in the 10-month cycle were the ones who never placed a bid, the patient saver. This member watched every other participant take their early payout at a discount. They paid the reduced rate every single month. In month 10, there is no bidding. All 9 settled members must pay the full $1,000. The patient saver collects the complete, unshaved $10,000 pot. Now run the math on what they actually invested over the previous 9 months. Because they never bid and always paid the discounted rate, their total out-of-pocket contribution was approximately $8,200. They collected $10,000. On an annualized basis, that's a return well above 20%. In some active syndicates, it hit 30% or higher. Tax-free, no brokerage, no Wall Street intermediary. These were completely unbanked refugees running more sophisticated capital allocation strategies from their living rooms than most Americans were accessing through their retirement accounts. And they used those returns to do it again and again. That is not a cultural story. That is a compounding machine. The HUI did not disappear when Little Saigon got big enough for banks to care. The system is still active in Vietnamese American communities today, and its mechanics have spread into other diaspora networks across the United States. The Korean Gi, the West African Susu, the Latin American Tanda, different names, same architecture. Rotating credit associations exist in virtually every major diaspora community in America. For the same reason, the formal banking system was never designed to evaluate these communities. What is new is technology catching up to the model. Digital platforms are now formalizing what the Chuhui has always done, pooling trust-based capital, rotating payouts, building credit records from the transaction history. Apps like Isusu and Mission Asset Fund are taking the Hui's core mechanic and wiring it directly into the formal credit reporting system. The shadow bank is going public, but understand what Little Saigon actually is before you accept any version of its story that calls it a miracle or a cultural anomaly. It is the compounded output of thousands of individual financial decisions, organized by women who accepted personal liability, enforced by social trust, so powerful it outperformed legal contracts, and ultimately flipped into institutional leverage using the bank's own rules. The greatest financial empires are rarely built inside a bank. They are built in the structural gaps the banks choose to ignore.